Welcome to the 3 Edge Week in Review for the week of January 22nd. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. So, here's something interesting to consider as we enter into this new year. Globally, 2024 could be one of the most politically consequential years in history, with national elections in more than 60 countries representing half of the world's population. More people will be eligible to vote in 2024 than ever before. Elections this year will not only have consequences for the U.S., but for the entire world. For example, in India, now the world's most populous country, they're due to hold a general election by the middle of this year that's likely to have over 1 billion people cast ballots. And Mexico is poised to elect its first female president in June. In Taiwan's election a few weeks ago, the winner was not the candidate preferred by the Chinese Communist Party on the mainland, and the new leader of the government in Taiwan ran on a platform where he promised to strengthen the island's defenses. So his policy decisions could certainly heighten tensions with Beijing. However, of all the elections across the globe, the election that will likely attract the most attention is the upcoming U.S. presidential election, which looks like it will come down to a rematch between President Joe Biden and former President Donald Trump. So today, Steve and I will discuss the potential implications of the U.S. presidential election, which is now only 282 days away, and its potential impact on the U.S. economy and the capital markets. There's a lot to unpack here, so let's get started. So Steve, as the November election fast approaches, investors are becoming more aware, and I would say also more concerned about the implications of the upcoming election. And they are seeking some degree of clarity amidst the uncertainty of just how the election will play out over the next 10 months. So I thought maybe we could start by having you comment on what we might typically expect every 4 years during presidential election years.
So, Fritz, it turns out that there really is an observed 4-year presidential market cycle, and there's logic to it. So, administration typically, after taking office or after the previous election, they'd like to take the economic or market hit early so that they can recover and finish strong before the next election, so they're in great shape going into the next election. Mm-hmm. And so it's really true that on average, the first 2 years of a presidential election cycle are below average returns in the stock market. And the second 2 years are above average. And the reason why this goes on is because there's a very high correlation between economic performance right before an election and does the incumbent win or lose. And so that's why there's such an attempt at managing that cycle. Now, what's a little bit atypical this year is that the current administration didn't, take its medicine early on at the risk of causing a recession or at the risk of a stock market downturn, setting up a recovery at the end. This administration has been enacting massive stimulus from the very beginning, nonstop. And so we haven't had that recession. And the question is, will the economy, which is strong now, continue right on up until November, or will it run out of steam? Will the monetary tightening that was done earlier finally kick in and cause a slowdown just before the election? That's a really big question that we'll have to see.
All right. So, clearly we have a divided electorate here in the U.S., right? There's no doubting the divisions that we speak. So I wonder then if you could speak to, what might happen to the markets in the economy should one side win or the other? Will the impacts be different in those cases?
So first I want to say that while most do expect a rerun of Biden versus Trump, history shows that elections can have surprises. So it's not completely out of the question that there could be a shakeup to that scenario. And And one of the reasons is that there's certainly the threat of a health issue on either of those leading candidates. So that's one possibility. But let's assume that those are the two leading candidates. Then there are two big impacts that an election can have that I want to focus on that impact the markets in a big way. One is the tremendous government debt that's piling up exponentially and the annual deficits that feed that. And the second are the question of tariffs. And even though there are so many differences between the two candidates and the two parties, one of the commonalities is that in both the previous administrations, both the Trump administration and the Biden administration, deficit grew rapidly. For different reasons, but grew rapidly in both administrations. And there seemed to be much more desire with different spending priorities, nevertheless, to deficit spend, to spend much more than the government's pulling in. Mm-hmm. And that was not an issue because it didn't cause pain when interest rates were so low. It's only been recently that interest rates have been elevated way above the zero. And there's a lag, but as the government has to roll over the debt, all of a sudden, instead of rolling it over at 0.5% or 1% or 2%, it's rolling it over at much higher interest rates. And that means the interest expense goes way up, and that just further adds to the debt. It's like a spiral. And this is a big issue that everyone says, oh, well, people have been crying wolf for a long time. It's never mattered. Well, you have to look at the math and see why it didn't matter as much before and why it can matter now. And both parties are poised to exacerbate the deficit. So that's one factor. And the markets are going to have to deal with that. Will the bond vigilantes come back in like they have in history when there's so much deficit spending and interest rates start to climb? They don't want to take on the interest rate risk, so they demand even higher interest rates, and you get this snowball effect, this feedback loop that goes in the wrong direction. Second, tariffs. The Trump administration issued tariffs that elevated the costs of importing from certain countries. The Biden administration didn't remove them. They largely kept them. The Trump candidate position is we're going to do much more with tariffs. And tariffs is just another word for tax. Right. And a big worry, whichever administration does it, a big worry about tariffs is that the first order effect seems noble. It seems that, well, we're protecting our own employees. We're protecting our own workers. We're protecting our own manufacturing. But it's very naive because there's a second order effect and a third order effect. And those ripple effects are that anytime there's been tariffs in the past, there's always been retaliation. And it's like game theory. Everybody loses. And you get a global slowdown. Also, with tariffs, often that just causes interest rates to go up. That causes the dollar to strengthen. And it negates all the effect of what was supposed to be the tariff in the first place. So it's just a way to weaken the economy. It's stagflationary. And yet that seems to be a big principle. And not just in one camp, but we've already seen that both camps have supported tariffs. So while there's so many differences, here are two very important impacts on the market that can be worsened by both camps.
Very interesting. As always, my final question is based on what we've discussed here today about the implications of the U.S. presidential election. How might investors consider positioning their portfolios as we get closer to the election in November? And I do feel that this is really an important question right now with all the uncertainty surrounding how this U.S. presidential election will play out. So what are your opinion there in terms of positioning?
Well, as we said previously in earlier videos, this is a time of radical uncertainty, and the election certainly feeds on that. And when you have radical uncertainty, it's more important than ever to be diversified across asset classes, because while we can do our best research, where people can make their best assessment as to what's likely to happen, there are outcomes that haven't been determined yet because they depend on decisions that haven't been made yet. And so one must consider different scenarios, different phases of the market, and at least some part of one's portfolio should accommodate each of those different phases. Now, having said that, there is an interesting dynamic going on. And we talked about this a little bit last time as well. And that is that it's more clear than ever, and our research shows that the equity market is being driven, especially in the US, is being driven more and more by psychology and not by fundamentals or valuation. Psychology is driving the market. It's very similar to what happened in the late 1990s. And when you study market history and you see rallies and bull markets that go on for a long time that become very driven by psychology, you have to allow for the possibility of what's called a market meltdown. And that's the idea that despite the fundamentals, despite the valuations, there's so much fear of missing out. There's so much riding the trend. There's so much let's participate, that some of the strongest market rallies happen either at the very beginning of a bull market or at the very end. And we're late cycle, so we have to allow for the possibility that we're still in the stages of a market melt-up, which could be quite spectacular. And the key is not to be a buy and hold investor. The key is not to put all of your money because you might not be able to get out in time, but to have some participation and allow yourself to at least participate somewhat in what might possibly be a market melt-up. So we do have U.S. exposure, and we've had a breakout. We're at all-time highs, and sometimes rather than people saying, oh, the market's too overvalued, in the short term, they say, oh, let's jump in and play along with this run-up. So that is possible. Having said that, conversely, once you think about what are the best hedges against equities, because inevitably they will correct, and the stronger the market melt-up is, the bigger the correction is. And in 2000, we had a magnificent, tremendous market melt-up, especially in the technology stocks. And then the NASDAQ 100 index fell over 80% from 2000 to 2002. So you need a hedge against equities. And number one, right now, with the potential of the monetary tightening finally kicking in later this year, we have to look at short-term treasuries as an excellent hedge. And then if the Fed tries to come to the rescue, then gold will be an excellent hedge because that'll weaken the dollar. And another excellent hedge are tips. Unlike a few years ago when you had a negative real return on tips, right now the market is rewarding you with a positive 2% return on tips.
Excellent. All right. Well, thank you very much for your insight today. It's clear from talking to our clients and advisors that we work with that there is a heightened degree of uncertainty around this election, and investors are, they're frankly a bit nervous. And this reminded me of a quote from Nassim Taleb where he said, it's better to invest in preparedness than in predictions. And I think that's certainly a good description of our investment approach, and certainly the way you talked about how one might consider being allocated at this point in time. And I think that there's no question we'll have another bite at this apple in terms of making more videos about the election as this thing plays out over the next 10 months. So that will do it for Steve and for me this week, but we will be back again next week with another edition of the 3Edge View from the Edge. As a reminder, all our videos are always available on our 3Edge YouTube channel. If you know someone who you think might enjoy and benefit from these weekly videos, please feel free to share them. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.